Today in crypto. Bitcoin yesterday saw its largest daily red candle in its history in terms of total dollars moved. Today, the selling has continued, and it has caused the MACD to turn bearish for the first time since the leading cryptocurrency by market cap took out $20,000. Is this a sign of a short-term reversal, or is the top of the bull market already here? Here's what the moving average convergence-divergence indicator says about the recent price action in crypto. Bitcoin started off the year with among its sharpest weekly advances yet, taking the asset from under $30,000 to above $40,000. The rounded number more than double its former peak posed the first resistance for the asset since the breakout from $10,000. The rally began, and Bitcoin never turned back, at least until now. Although bulls have been in control for months now, hidden bears attacked above $40,000 and sent the cryptocurrency tumbling by over $10,000. Related reading: Bitcoin bloodbath. How the dollar turned the sea of green-red yesterday set the record for the worst daily close in the asset's short, 12-year history. The fallout could have changed the bull trend bearish and brought fear back to the otherwise overly exuberant crypto market. The selling has since continued, but bulls are keeping prices at bay currently and prices consolidating. The sell-off, however, was enough to turn the MACD red on the histogram for the first time on daily time frames since $20,000 was taken out. The moving average convergence-divergence indicator is a trend-following, momentum measuring tool consisting of two moving averages that converge and diverge. Because of the way it works, it is often disregarded by analysts as a lagging indicator. Bitcoin's MACD histogram only now flipping bearish following a nearly $10,000 sell-off demonstrates this lag, but that doesn't discount its efficacy. Crossovers of the two MACD lines can act as a confirmation signal that solidifies that the trend is changing. Related reading: Bitcoin uptrend from $20,000 has been lost according to Parabolic Indicator, and because the MACD focuses on momentum and recently became so elevated, the eventual correction will have more gravity to it. The histogram turning red on daily time frames, unless bulls can uncross the two moving averages, could extend for days to come. However, it is important to note that like any technical analysis indicator, more weight is given to higher time frames, and on weekly and monthly time frames that count the most, the momentum is still pointing upward overall. To use the MACD effectively on the way back up, a confirmation the daily bull trend has resumed would arrive with a crossover of the moving averages to the upside. Brian Brooks, crypto-friendly bank regulator, expected to step down this week, report. The acting OCC head will reportedly end his brief tenure running the federal banking regulator by the end of the week. Gensler said to be named SEC chairman, Reuters. Gensler has testified before Congress about cryptocurrency and blockchain on multiple occasions. Is China poised to nationalize Alibaba? The International Business Times reports China might nationalize Alibaba. Here's what that has to do with China's digital currency efforts. By Geoffrey Smith. Investing.com. The first bubble alert of 2021 hasn't taken long to materialize. The price of Bitcoin rocketed by 44% in the first 8 days of the year, as investors big and small poured money into the digital currency on the back of investment bank advice sketching out the prospect of almost unimaginable gains. As so often with Bitcoin, the rally quickly gave way to a sharp sell-off, but the dip quickly found buyers and the uptrend of the last few months remains firmly intact, with an increasing number of Wall Street's finest lending their seal of approval to the digital currency. Its momentum seems unchecked for now. JP Morgan followed Citigroup last week in publishing research that put an eye-popping notional value on Bitcoin, based largely on the premise of it replacing gold as the preferred store of value play for investors of the digital age. Strategists led by Nikolaos Panagurtsoglu noted that investors still have over 4 times as much tied up in gold coins, bars and exchange-traded products. Shifting all that into Bitcoin would theoretically take the price as high as $148,000, they argued. In December, Guggenheim's Scott Minerd had used similar reasoning to slap a price of $400,000 on the currency. Yet it was Minerd, more than anyone, who contributed to one of the familiarly gut-wrenching sell-offs over the weekend by saying that the rally over $40,000 had gone too far, too fast, and that it was time to take some money off the table. Bitcoin prices subsequently fell 21% over the next 48 hours. Store of value, indeed. In fairness, the more thoughtful Bitcoin advocates don't make any claim to it being a store of value today. Instead, they argue, it is a status that awaits Bitcoin at the end of a long journey toward acceptance, in which early scandals of poor custody, money laundering and wild price swings with no transparency are but distant memories. And in some respects, the rally of 2020-21 does indeed look more fundamentally solid, in that the inflows are coming largely from institutional investors playing the long game, rather than retail investors in a hot flush of FOMO. Tellingly, this rally has not been accompanied by a rash of essentially bogus initial coin offerings aiming to take the latecomers for suckers. Skeptics can still argue that Bitcoin still doesn't, and probably never will, fulfill of the three functions of money, namely, to act as a means of exchange and a unit of account. No major merchant will accept it, and no tax authority will accept payments in it. Bitcoin advocates argue, with some justification, that the same applies to gold. However, the comparison only goes so far. Gold has an age-old relationship with jewelry and ostentation, that has the functions of satisfying human vanity and heightening human lust in a way that abstractions such as digital currencies can't. However, such considerations are playing little part in a rally driven by loose central bank policy and negative returns on traditionally safe assets such as bonds. Over $18 trillion now offer negative yields, according to some calculations. Both gold and Bitcoin prices may yet be vulnerable if central banks succeed in reflating their economies and restoring a world positive returns on safe assets. But it would be a brave investor that bet against digital currencies in the near term. Hit the like button and subscribe to the channel.